And so what we're going to do is we're going to guarantee you to have access to that capital through the form of a loan. And what we're going to do is we're going to utilize the cash value in that policy and the death benefit when you die as a form of guarantee to make sure that loan or that you have access to that money. And we're going to make sure that when we give you that money, that we guarantee that loan with the cash value and with the death benefit, right? So if for some reason you try to surrender the policy or cash this policy out, we know that it's guaranteed. So we know we're going to take that money out of this account. We're going to pay the loan back if you ever try to do that. Or if something happens and you pass away before the death benefit is paid to your estate or your heirs, we're going to reduce the death benefit by the amount of the loan, and everything will be washed out and it will be clean, and we will go from there. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, we're going to be talking about something really fun for me. It's kind of a controversial topic, and that is, do you pay yourself interest with infinite banking? Now, before I get into any of that, I think it's really, really important to kind of flush everything out here and talk about this, because if you watch this channel, you know that I'm a big advocate and I'm a big proponent of utilizing whole life insurance as an asset that, should be what I would consider a foundational or tier one asset in everybody's financial life. Now, that being said, infinite banking is simply just a philosophy or a marketing concept on how to utilize properly designed whole life insurance contracts to improve the efficiency and effectiveness and maybe create a system for your financial life. It's that simple. It doesn't need to be made more complicated than that. Now, at the same time, what happens is people, they kind of twist it and they make it into something that it's not, and they make it more complicated than it needs to be, which ultimately makes me kind of sad because of the fact that this is so awesome on its own and it doesn't need to be made more complicated. And the marketing brain in me, because I don't know if you know this, but I also own a marketing agency and I do a lot of stuff with ClickFunnels and stuff like that. But the marketing brain in me always says, well, a confused mind always says no. And I feel like if everybody knew about how whole life insurance worked the way that I know about it, then it becomes the biggest no-brainer decision in the world of the problems that it solves in every person's financial life. Now, is it the right thing for everybody? No, but for people with the right discipline, for people with the right vision and the right ability or capacity to go out and create impact and to actually create velocity and produce in the world, for anybody who's got a producer's mindset, I guess is the easiest way to say it, then utilizing whole life insurance as the foundation of your financial life becomes a no-brainer. Now, that said, one of the biggest things I always tell people when it comes to how we talk about whole life insurance is that words matter. And when I say that words matter, it's because of the fact that one of the most common ways that infinite banking is missold is the fact that there's a lot of people out there telling you that you can pay yourself interest. And while there are many ways that infinite banking is missold, I think this is the most common way that it is missold. And so let's break that down for a second. So if you were to be able to pay yourself interest, what does that look like? Well, I think it's really important to understand the moving dynamics of a properly designed whole life insurance policy and how the loan provision works when you implement it, when you utilize it. Now, let's just use an example. Let's say I have $100,000 inside of my account, inside of my whole life policy. I got $100,000 net cash value sitting there that I have access, that I have liquidity, use, and control of. When I want to leverage that money, let's say I have a real estate deal. If I wanted to go leverage that money, basically what this is saying is that if I were to take a $50,000 or let's just call it a $60,000 loan because I needed 20% down on a $300,000 property, and I was going to leverage some of that $100,000 to go out and get that property. Now, the idea is if I could borrow from this policy, this is what a lot of people say. They say you could borrow from your policy and you can pay that policy back at whatever interest rate you want. So the idea is they're saying, well, you borrow at 5% and then you can pay back at 10%. And so you get to write the extra interest off, right? And it doesn't really work that way. And it doesn't, not only does it not work that way, even going down that path gets confusing. And here's the deal. So let's break it down why that doesn't work, because you're not ever borrowing money from your policy. This is the power, because if I was borrowing money from that $100,000, that means that out of that $100,000, I would take this $60,000 loan, I would be taking it out of the policy. And as soon as I'm removing that money from the policy, I am now interrupting the compounding of that $60,000. So I'm picking up an expense. However, what I'm really doing is borrowing against the policy. And this is an area where a lot of financial people and a lot of people online either misrepresent or just don't understand how this really works. And so what you're really doing is you're borrowing against it. You are utilizing this cash value as collaterals, because what the insurance company does is they say, listen, Chris, well, you have $100,000 sitting in this account. And so what we're going to do is we're going to guarantee you to have access to that capital through the form of a loan. And what we're going to do is we're going to utilize the cash value in that policy and the death benefit when you die as a form of guarantee to make sure that loan or that you have access to that money. And we're going to make sure that when we give you that money, that we guarantee that loan with the cash value and with the death benefit, right? So if for some reason you try to surrender the policy or cash this policy out, we know that it's guaranteed. So we know we're going to take that money out of this account. We're going to pay the loan back if you ever try to do that. Or if something happens and you pass away before the death benefit is paid to your estate or your heirs, we're going to reduce the death benefit by the amount of the loan, and everything will be washed out and it will be clean, and we will go from there. Now, when we leverage this, when we collateralize our policy for this $60,000 in the example that I'm giving, what happens is we're paying a loan for that. Now, a lot of people, the Dave Ramseys of the world, say it makes no sense to pay to borrow your own money. Once again, you're not borrowing your own money. This is the key component to this. If I could earn money continually in this account and it's going to keep growing because I'm never taking the money out of the account, well, that's awesome. This is why I say it's just a system. The bank is just giving it to me because I'm utilizing the money that's in this account in my whole life policy, and it's going to keep growing. Now, they're going to guarantee my loan with that money, right? But it's two separate transactions. Now, the cool part for the insurance company is they say, well, we're going to loan you money at 5%. Right now, that's the going rate as I'm filming this video. That rate changes year to year, but they say, I'm going to loan you money at 5%. And by the way, the cap on this in the policies that I have are 8%. Right? So with where we are in the world right now, I just looked at an article from the New York Federal Reserve this morning, and they said they expect mortgage rates to be upwards of more than 8% very, very shortly here. So contractually speaking, the power and the leverage of being able to have a guaranteed access of capital where the highest interest rate that you would ever pay would be 8% is potentially very valuable. That's a little side note, but it's just something that kind of came to my mind that I wanted to share with you. Now, at the same time, when we get this loan from the insurance company, it's guaranteed because we have this account, but it's an asset on the insurance company's books, right? So they have to guarantee our policy growth and our policy value, but now we take a $60,000 loan for a down payment on an investment property, on a turnkey property that I talk about a lot in my book, Cash Flow Hacking, right? We do that, and here's the deal. We're paying back 5%. We're paying it to the insurance company. Now, if we're utilizing this as a business loan, that 5% is that interest expense is a write-off. Now, can we write it off more than that? Yes. I mean, I guess you can try, but here's the deal. If I write off 5%, right, that is a pure expense that's going to the insurance company. If I try to say I'm going to pay 10% back to the loan, what's happening is you're not paying additional interest to yourself, because remember, this 5%, that loan is not to you, that's to the insurance company. So if I try to pay 10% back, all I'm doing when I pay the 10% back is I'm paying back the interest, and it's going back to increase my collateral capacity. It's paying down the principal of the loan, and what's going to happen is it's going to open up more collateral capacity. It's going to increase my reserves. It's going to become more liquid and more available, which, by the way, is a fantastic thing because it's going to open up opportunity for me if I find more rental properties, if I find other investments that I want to take advantage of, that money will become reliquid. Because remember, if I had $100,000 in my account and I borrowed 60,000 of it, and then I have this loan over here, that means my collateral capacity, the available line of credit, let's say, that I have access to in my system is only 40 grand, right? So as I pay this $60,000 loan back, this 40 grand becomes bigger. It becomes 45 and 50 and 55 and 60. And as it gets bigger and bigger, I'm obviously opened up for more and more opportunities. But back to the point here is, as I pay this back, I'm not able to pay myself more interest. If I go pay 10% there, and let's just say I wanted to try to claim it and write it off. Well, if I'm paying that interest, then somebody's benefiting from it. Now, as a business, I could write it off. Like if I had that property owned in an LLC, I could write that off as interest expense. If I paid the 10% interest expense on the on the property in the LLC, but here's the deal. 5% of it is clean. If you ever get audited, that 5% is clean because it's going to the insurance company. The extra 5% that you claimed that you wanted to put back in there, where's it going? It's going to you. It's going to the policyholder, the individual, which is you. So if you're writing that off as an expense on the business and you ever get audited, you are going to run into an issue on your personal taxes, because if it's an expense over here, that means it's what? It's an income for somebody. So you're going to have to claim it. Now, this is where I think it's crazy that people are trying to do this, because can you get away with it? Well, guess what? You could try to get away with anything that you want to get away with, and it works until you get audited. And I'm just a big believer you shouldn't be, towing that line that crazily, I guess, is the way to put it. Like, it just doesn't make any sense to me. So what I look at this as is that the system in general works so cleanly, and that it's so effective and so efficient and it's so powerful when you understand that utilizing a properly designed whole life insurance policy is the only way to make sure that your life will get better and better and better on a guaranteed basis for the rest of your life if you just follow a plan and you execute it and you contribute to it and you participate and you utilize this as the foundation of your financial life. Not only will it increase your value as you go through your life, but it creates generational wealth. It creates a lot of opportunity for your kids and your grandkids, and you have the ability to create what you want intergenerationally for your family. Now, that said, once again, this is the most oversold component of it, and is the fact that you don't pay yourself interest, and so don't fall into that trap. That said, if you are confused about that, if you look at this and you say, well, this doesn't make any sense, this is why I haven't pulled the trigger, life insurance isn't a good investment, I can't pay myself interest, I'm here to tell you that while all that is true, life insurance is not a good investment. It's a great savings alternative, and you can't compare life insurance to investments because of the fact that it doesn't have the same risk profile as an investment. It has a very similar risk profile to a savings account. And when you look at the benefits of a whole life policy compared to a savings account, it becomes a no-brainer at that point in time. Now, on the other side of this, when you look at it, is the benefits of being able to loan against it, to borrow against it, and to be able to have access to this capital, and to be able to have a system, and you realize it's not an investment, and the fact that you have all these other advantages that you can flow through this policy to accomplish that what you want to accomplish on a systematic basis, and the rules that will come into play, and the principles and the habits and everything that you will implement in your life, you realize that all this nonsensical talk about paying yourself interest, you'll realize it doesn't matter. And when you can clear that up, it can start to make sense for you. So my encouragement to you is get beyond the concept, get beyond the internal talking about how to pay yourself interest, because it doesn't work that way. And once you do, now your mind can open up on how to actually leverage these policies, and that's it. So if you have any questions about this, because I know it's really hard to cover all this in a 10-minute video, but I encourage you to comment in the comment section below. If you haven't already, make sure you subscribe, hit the bell, that way you get notified every time I launch a new video. Check out, I will at the end of this also attach the infinite banking playlist that I have that talks about all these different topics. I try to simplify it down to its most basic parts, that a 10-year-old could understand ultimately, hopefully. And that's it. So That's it for now. If you have any questions at all, feel free to reach out, chris@life180.com. Till next video, have a blessed, inspirational day. We'll talk soon. See ya.